Hello and welcome to another episode of the Just Got Paid podcast. I'm your host, Eric Hellon, and on today's episode, we're going to talk about some upcoming changes to student loans in America. So if you've heard some of these latest headlines, there's some big changes coming to student loan repayment in May of 2025. And so I want to touch on some of these changes that are coming, some pros, some cons, and even some things that you can do if you find yourself in default and how to work your way out of it. So we're not just going to talk about the problems and the negative headlines. We're actually going to talk about solutions and ways that you can overcome these changes to make sure you're still stable financially. Now, if you don't know much about student loans, we have about 43 million Americans that have student loan debt. And of those 43 million Americans, that makes up 1.7 trillion with a T, trillion dollars worth of student loan debt. That is a lot of money. And so there's a big rush to figure out what these changes are going to do and how they're going to impact those folks, especially the ones who are already in default. People often say, well, student loans are a young person's problem. But actually, according to the Federal Reserve Bank of New York, everyone who's about 24 or younger with student loan debt only has about $14,000 worth of debt. The highest debt holders are actually 62 and above, who have an average debt of $43,000. So older folks who went back to school to get their degree and oftentimes use student loans to do so find themselves in more debt than those in the younger generation. So this problem affects us all. And when I mean all, I mean me too. I have student loan debt. It's in deferment and it's only going to become due here soon. And so I've been keeping my eye on how these changes are going to come, what programs that they're getting rid of, what programs they're improving, and how ultimately it's going to impact folks who are working their jobs, who are trying to build their careers, and who are trying to buy their first home. And so we're going to dive into some of these changes to really discuss how you can be prepared for these changes to come. Now, the biggest headline that everybody's been hearing is the change that's coming on May 5th. As of May 5th, the changes will come so that anybody who is in default on their student loans can be reported to their credit bureaus. Now, this was put on pause back in 2020 due to COVID, and it remained on pause even through the different administrations. But as of October 2024, repayment started back. However, we're finding that a lot of people are having a hard time recovering. We have things going on like tariffs. We have people having a hard time finding work. And so student loans are getting backed up. And so for you to go into default on your student loan, you actually have to go 9 months without making a payment. I know people often think, well, hey, as soon as you go 30 days, then it's in default. That's not the case. 9 months of non-repayment puts you into default. And as of May 5th, that means that default can be reported to your credit bureaus. So you have TransUnion, Experian, and Equifax. If it gets reported to your credit bureaus, then obviously it's going to take a hit to your credit scores. So this makes a big difference. If you're looking to buy a car, if you're looking to buy a house, it's going to impact your credit score. And ultimately, you're going to have to pay a higher interest rate to do those things. Another part of this default is actually that they can go after your wages if you're a federal worker. So those who work for the government, they can garnish your wages and take payment directly from your paycheck before you even see the money. Even if you have direct deposit, they can actually reach into your bank account and take that payment from you. And so if you work for the government, right now they're saying this is happening more so going to happen to federal workers, but it could impact everyone soon. But the biggest thing is that the wage garnishments will directly come from your pay without you even having a say so. So if you are in default, it can be garnished. Another thing that they can do is if you're collecting Social Security benefits or if you're planning to get a tax refund, then they can actually pull the money from there as well. So when I talked about those who are in the older generation who have quite a bit of student loan debt, it could impact their Social Security benefits. So that way they're not even getting the little money that they were expecting to get every single month. We all know that Social Security doesn't pay much, and for some generations, it may not pay at all. But we know that those payments are very important. And so if we're taking from those Social Security benefits, it will have a direct impact on some of our parents and grandparents. And I did mention tax refund, which is a great point to bring up right now because a lot of people have recently filed for their taxes. They think that they're going to get, a fairly large payment, and this could come back to haunt them. So, they could take directly from your tax refund an amount owed on the defaulted student loans, and they could actually make your full student loan effectively due immediately. So these changes that are coming as of May 5th are something to be aware of. It is a problem to a lot of borrowers who find themselves in default. Right now, there's 5.3 million student loan borrowers who are in default. And there's another 4 million who actually are 90 to 180 days past due. So they could be in default very soon. Now, there is a positive to some news coming out about these changes with student loans because on May 10th, their IDR, which is your income driven repayment plan, they had actually took those plans away for a while, then they brought them back, and there's been a lot of changes. And even these changes that I'm talking about today on this episode, they may not come to full fruition. So we don't know, but you need to be aware of them and be prepared because the IDR programs that they're rolling out, they're going to make a major change to how they're repaid and how they're factored. So let's say that you have a spouse who's working and earning income. As of May 10th, the changes to the IDR repayment plan is not going to take into consideration their income when it's factoring in how much of a payment you can afford. So if you're single, this doesn't really impact you, but if you are married, it should have a better impact on the amount that you have to pay. So you should have to pay less every month because it's not taking into consideration your spouse's income. So if there is one silver lining about the changes to come, that is a positive. So a lot of married couples won't have to consider their household income when factoring in those new IDR payments. It will be solely based just on their income. Now, if you are familiar with repayment plans when it comes to student loans, you've most likely heard of the SAVE plan. This was a plan that was implemented and introduced by the Biden administration, and it factored in not only your income, but also your family size. And a lot of people actually thought that this was a great plan, but the federal courts actually did shut that plan down. And so, like I said, there's been a lot of changes to student loans. There's been things that have come up, new plans that have been introduced, some that have been removed. This is one that was removed, and they don't plan to bring it back. So don't expect to take advantage of the SAVE plan. If you've heard of that plan or if you were on it before, we don't expect that plan to come back with these new changes that are coming in May. So with these changes to come, if you're concerned about wage garnishments, tax refunds being taken, or even Social Security benefits being taken, then you need to have a conversation with your loan servicer right away. If you're falling behind, if you're not being able to make the standard payment that you have for your student loan repayment plan, talk to your loan servicer. That's the first thing that you need to do. You can actually visit studentaid.gov and you can run some loan simulators, some calculations, and even use their AI assistant called Aiden to kind of figure out how much of a payment you can truly afford. Figure that out, talk to your loan servicer, and really get to getting caught up. You don't want your wages to be garnished. You don't want your income to drop because of this. And you definitely don't want this to impact your credit score if you're looking to buy a home. So think about those things, have those conversations early, and figure out a way that you can get caught up. One way that you can get caught up is actually called a loan rehabilitation. Now, you can only do this one time, so make sure that you truly, truly need it. But in order to do a loan rehabilitation, you will have to provide some greater detail to your household income, your expenses. There will be forms that you have to complete. You have to kind of take a deeper dive looking into your full financial picture in order for them to figure out how much of a payment you can truly afford. So start out with a conversation with your loan servicer, try to get caught up, fill out, a new IDR program where maybe you're not including your spouse's income, maybe that drops your payment. And if things are really, really bad and you just need to get caught up so that you're not facing these huge problems coming down the pipeline, talk about the loan rehabilitation. But just remember, you can only do it one time. The reason I wanted to focus on student loans in this episode is because we've talked a lot about recessions and tariffs and things that could impact your personal finances, but nothing impacts your ability to buy your first home quite like a student loan. I mean, some of those payments that I've seen over the years can be pretty significant. And so that gets factored into your debt to income ratio. And actually, you'll get qualified for a lower value when you go to try to apply for a mortgage because your interest rates will be higher and your debts will be higher. So definitely have these conversations. Figure out how you can lower your payment to the lowest amount possible before you try to go out and buy a home. This could potentially have a great impact to our economy. What we found from recent history and some of the statistics that are out there is that people who have a lot of student loan debt are less likely to start a business. So we don't have small business startups like we need. They're less likely to buy a home because they're carrying heavy debt burden and they can't figure out how to pay for their mortgage. And overall, they just spend less in our economy. So this is kind of an anti-stimulus package, if you would. If these things come into play, people will spend less because they're worried about catching up and staying caught up on their student loans. So even if you don't have a student loan, even if you're saying, well, hey, this doesn't impact me, it does. It impacts the entire economy. And so we have to be prepared for these changes to come. If you still have questions about some of these changes and your unique situation on how you're going to handle your money, or if you're getting prepared to buy a home, you want to see how this is going to impact that process, don't hesitate to reach out. I can chat with you and discuss your personal situation and figure out, what's the best strategy for you. But have a conversation with your loan servicer first. Figure out what your options are. Figure out how to get your payment as low as possible so that you can maintain that payment, get caught up, and as your income grows, and you can catch up a little bit more and accelerate those payments to get your student loans paid off. I don't want you to hold on to this debt for life. Like myself, we have these debts that we have to repay, but I want to make sure that you can afford those monthly payments, even with your current debt obligations. And most importantly, I don't want it to get reported to your credit reports as a negative impact because that will hinder things that you want to accomplish in the future. I truly hope that you got some value, some information, and some solutions from today's episode. If you have any questions at all, don't hesitate to reach out. And until the next episode, be blessed.